You've seen it happen. Bitcoin drops 20% in a single day. Crypto Twitter is in absolute panic. Portfolios are liquidated, and retail investors are left holding the bag. But while the masses are panic selling, a select group of elite players, the crypto whales, are already positioned for the drop. They didn't just guess. They knew it was coming. How? Because they aren't trading on emotion or Twitter hype. They are using advanced artificial intelligence to track on-chain data, spot hidden patterns, and predict market crashes before they happen. Today, we're exposing the exact AI strategies whales use to front-run the market and how you can use them too. The biggest lie in crypto is that market crashes happen out of nowhere. To the untrained eye, a flash crash looks like a random act of chaos. But on the blockchain, nothing is hidden. Every transaction, every wallet movement, every transfer to an exchange is permanently recorded. The problem isn't that the data isn't there. The problem is that there's too much of it. Millions of transactions happen every day. For a human, it's noise. But for an AI, it's a map. Whales don't dump $1 billion in one market order. That would destroy the price before they could exit. Instead, they use a process called controlled distribution. They slowly, quietly move their assets onto exchanges over days or weeks, selling into the buying pressure of retail investors who think the market is still going up. This is where artificial intelligence changes the game. AI models don't just look at price charts. They analyze the underlying behavior of the network. They use clustering algorithms to connect thousands of anonymous wallets, revealing the hidden networks of single, massive entities. If a whale splits $1 billion across 50 different wallets to hide their tracks, an AI can use graph analysis to link them all back together. It tracks the flow of funds. When AI detects a sudden, coordinated movement of massive amounts of Bitcoin or Ethereum from cold storage wallets into centralized exchanges, it flags it. This is the ultimate leading indicator. An influx of crypto to an exchange usually means one thing: the whales are preparing to sell. But AI doesn't rely on just one signal. It builds what's called an on-chain signal stack. It analyzes metrics like the spent output profit ratio, which tells us if the market as a whole is selling at a profit or a loss. It looks at net unrealized profit and loss to gauge market euphoria. When these metrics reach historical extremes, when everyone is in massive profit and greed is at its peak, the AI knows the market is overextended. Combine that extreme greed with AI detecting massive whale deposits onto exchanges, and you have the recipe for a crash. The AI isn't predicting the future with magic. It's calculating probability based on the immutable laws of supply and demand playing out on the blockchain. So what tools are actually doing this? Platforms like Nansen and Arkham Intelligence are at the forefront. Nansen uses AI to label over 500 million wallets, specifically tracking what they call smart money, wallets with proven track records of massive profitability. Instead of tracking random noise, Nansen lets you see exactly what the most profitable funds and whales are accumulating or dumping. Arkham Intelligence takes it a step further with its AI engine, Ultra, which de-anonymizes the blockchain. It links anonymous wallet addresses to real-world entities, hedge funds, institutions, and major influencers. When a massive wallet moves funds, Arkham's AI can tell you if it's just a routine transfer or if a major institution is quietly liquidating its position.